Welcome to the Daily Update, where I'll go over the action in the market from Monday, July 31st, and then we'll see how things look for Tuesday, August 1st. We had a bit of an up day. It really just came right at the end of the day. A buy program right at the last few minutes just shot prices a little bit higher. We're still looking positive. We're getting a little bit more overbought. You could also suggest that this is good momentum. But at the same time, we're coming into a weak seasonal time. We've been in it already, and the market's held up pretty well. We'll have to see if there's any weakness going forward from here as we enter the month of August. The first thing I want to say today is thank you very much. If you can see up here in the corner, I hit 1,000 subscribers. It's been a lot of work. It's been a lot of videos. And the fact that even though I've been an educator my whole professional life, the idea that people would want to come and watch videos that I produce is a very humbling experience. And I'm very grateful for that. And I don't know who subscriber number 1,000 was. Sometimes I get notified when somebody subscribes. Most of the time I don't. It's a privacy setting that people have. But whoever you are, thank you, and thank you to all of the other people that have subscribed. About half of the people that watch the videos don't subscribe. That's kind of typical to what happens, but just subscribing really helps. There might be some changes a little bit now that I've gone over the 1,000 mark. I'm still waiting to get the confirmation email from YouTube because they want to make sure, is he going to stay above 1,000? This was a personal goal that I set, and just to be able to achieve this is very deep and special to me. So thank you for that. I'm going to be playing around with the thumbnails again. If there's one criticism that I get and why more people don't watch the videos than already watch them, it has to do with the thumbnails. And I'm just not good at that kind of a thing. I'm going to be playing around, seeing what I come up with. If any of you have any ideas, I'm more of a detail, linear, logical type of person, and that's how I teach. I can't even draw a stick person to save my life, and I write like a doctor. This is just an area that I'm weak on. I watch videos, and pretty much every video I watch says, oh, this is the best way to do it. And then I watch another video, that's the best way to do it. So I'm kind of just trying to play with this and see what should be done in that whole area. Don't be surprised if you start seeing some different looking thumbnails coming up. Any feedback, I would really accept that because this is an area where I am quite weak. You notice that's why I use PowerPoint. That's why I don't use a lot of graphics that I drew myself. I use other graphics that I can pull from. That's just not a talent that I have. And while I'm thinking about it, please be reminded that I do have a private Facebook group. I'm really trying to activate that a little bit. So far, I'm the only one that really posts anything. The only time that I announce that I have a Facebook group is in the weekly video. I keep all those other announcements at a slide right at the end of the video, but a lot of you probably click off before that even comes up. But I'd like to get some back and forth going. I want to get some communication going and use that more. So consider that if that's something that would interest you. There's other alternatives, but right now I'm kind of focusing more on the Facebook groups. Let's go back and talk about what happened. We did have a gap higher open, and prices immediately climbed to R1 at 45.94. Then we retreated down below the unchanged level, and we found support at the daily pivot at 45.79. As the day went on, we chopped above and below the unchanged level and the daily pivot, and then we closed below R1. There was some last-minute buying that came in. We were up 0.15%, not a huge gain, but it still goes in the books as an up day. We were back to below average with volume. The only real above average day that we saw was last Thursday, and that's when we saw the big downturn. The technicals were positive, and the momentum is remaining positive, but we're also looking a little overextended to the upside and coming into a weaker period seasonally and historically what has happened in the past. It doesn't mean it's going to happen this time, but it has happened before. The markets are still fixated on inflation and interest rates. We still have this positive scenario in the background that we're wondering when is that going to change. We won't really get any Fed speak now because they're on vacation. There's no scheduled speeches. Unless they do an interview or make an appearance or something like that, we might not be getting much from them. And then we're also dealing with earnings season on a case-by-case basis. What are some comments that we can make? The broad market outperformed. This is more encouraging. We're seeing more stocks starting to participate as the market has been improving, and that's a good sign. Small caps were able to break above resistance. I'll show you that on the chart. We're still with this positive scenario in the background. The idea that we'll have a soft landing, that the Fed is almost done raising interest rates, and that earnings growth going forward still looks positive. On a short-term basis, we have the Williams percent R, the CCI 14, and the stochastics that are extreme positive. Intermediate term, we have the rate of change going back 50 periods, the PMO studies, the Sean trend meter, and the bullish percent index, both for the S&P and the NASDAQ 100. Those are all extreme positive. On a long-term basis, even though we're coming down a little bit, the longer-term moving averages still continue to be extreme positive as well. The dollar was up and interest rates were down. All of the yield curves that we follow still remain inverted. Sentiment really didn't change. We're still extreme positive at 78. With our trend, it's still positive. The green line showed a little bit of improvement. It turned up just slightly. The ADX is above its moving average. They're both close to 40, so that's a little bit of a concern. But it suggests that we're in a strong trending environment and that the trend is positive. Our bias is positive, and I'm still keeping our momentum at mixed to positive, mainly because of this potential seasonality that could creep into the picture. The economic reports that came out, we just had one. It was the Chicago PMI. It came in at 42.8. They expected 43. Last time it was at 41.5. Here is a chart of that. How we did come down almost to 40, and then we've been showing some improvement overall. We want to see this get above 50. That shows more expansion in the economy. Some IsabelNet.com blog charts. Analysts are expecting the second quarter to mark the bottom in margins. I drew an arrow right here to suggest this is what they're expecting right now. And then going forward, they're still looking positive. And this is giving some of that positive scenario looking forward to justify higher stock prices. Because ultimately it comes down to earnings. A company has to make money to justify whatever their stock price is. We're still looking at the probability of a recession. When we look at the yield curve, it's still very high. It's dropping down a little bit where it got up to about 80% and now it's coming down, but it's still a very high reading. A rare bullish breadth signal is close to happening. This already happened a year ago. In 2022, we saw that 90% of stocks in the S&P were above their 50-day moving average. We don't know what's going to happen. We're now looking in this area that's 12 months out. We know on an average we're up 17.3%, the median is 14.4%, and we're higher 92.3% of the time. Now earlier this year, when we were 1 month, 3 month, and 6 month out from that August 2022 reading, the market was still down after that. We'll have to see how things are calculated this time. We're looking at the 4-week rolling average. They've been positive going back to the middle of January, even though we are seeing it decline just a little bit. When we're above this zero line, that means money's going into the market. Looking at the economic surprise index, it continues to go up. This means when a report comes out, it's usually greater than expected. If we start getting too high up there, it's going to spook the markets a little bit and damage this positive scenario. Looking at the latest reading of GDP now, and I went over this in one of the videos over the weekend, where right now, since we're starting a new quarter, the range that they're predicting the GDP will be is a little bit over 1% all the way down to minus 1%. We're seeing some money going into materials, and that sector is improving slightly, and it could be one of those things just to keep an eye on, but we're actually seeing positive flows going into that sector. We're going to get the ISM this week, and if we go above 50, that could really suggest that the economy is improving when we look at the manufacturing PMI. The new orders and inventories have shown some improvement. Now we need to see this blue line start to turn up and go higher. I don't have the current market valuation charts to show you this time. I kept checking it over and over on the weekend to put it in one of those videos. They're changing it around again. They've added a VIX chart. They don't have their overall chart anymore. I'm not quite sure what they're doing with all that, so I'm not going to be covering that this week. Getting into our analysis and commentary, here is the intraday chart where we did gap higher. We went right up to R1 out of the gate. Then we fell back down to the unchanged level, came down to the daily pivot, bounced up a little bit, and then drifted lower and chopped pretty much between the unchanged level and the daily pivot. And then right at the end, we saw some kind of a buy program come in to really shoot prices higher. We would have closed down if that program had not come in. Here's the intraday chart where we saw some strength when the futures started to trade Sunday afternoon and evening. It came down a little bit when the cash market opened. We declined overall, but then saw some strength going into the close. And we're seeing things pretty much drift sideways, which is common in the initial overnight session. When we look at growth versus value, growth did outperform. The blue line's above the red line and we're above the dash line, so that means it was positive. On a closing basis, growth and value were just about the same. Growth was down just a little bit. It underperformed for the mid caps and actually outperformed with the small caps. Looking at the growth to value ratio for the S&P, we did close down just a little bit. We saw some improvement as the day went on, but then a little bit of selling going into the close. Keeping an eye on sentiment, the Ulster Index is suggesting there's just no fear right now. The VIX actually was up a little bit, and since we had an up day, that's kind of strange, but really that up movement came right at the end of the day. We ticked up just a little bit with the line chart as well as the bar chart. We're still below the moving average, suggesting that volatility in the VIX is dropping off. Here's another sentiment gauge showing that we're in extreme greed territory, so we want to be careful of that. Another sentiment indicator also is looking extreme positive. So we're seeing a lot of confirmations that the market continues to be exuberant right now, but it's been that way for quite a while. Keeping an eye on the equity put call ratio. This is the 5-period simple moving average. We did go up slightly. That's typically negative for the market. When this is going down, that usually means the S&P is going up. And we're crossing back above that 0.55 level. But in the longer term, we're still looking positive as the equity put call ratio continues to decline. Keeping an eye on this fear gauge, we ticked down just a little bit and we've been declining overall. The other fear gauge also continues to decline. We saw a little bit more of an improvement with our risk on, risk off ratio as it's ticking back up. Folks are favoring stocks over bonds. Our advanced decline line did see some improvement based on price and volume. These are looking pretty healthy for right now. The new highs also had a good day, but we are dropping off. It's going to be difficult for the market to generate a real explosive growth in new highs until we break above this resistance that's above current prices. The advanced decline ratio ticked up and is above 0. That's positive. Accumulation distribution showing some improvement. We're right back up to the moving average. The red line's rolling over just a little bit. We've been keeping an eye on this. We're looking positive on the weekly chart, but we saw some weakness here on the daily chart. We'll see if that continues to improve. This tries to measure what the smart money is doing. Looking at the cumulative advanced decline line for the NYSE, we're showing some improvement here. We're not quite back up to this previous high. When we look at our regular advanced decline line, we're showing even more improvement where we're breaking out above these previous highs. The other advanced decline line continues to show some strength as well. When we look at common stock based on price, seeing some improvement and coming back up to this previous high, seeing a little bit of a negative divergence. Even though volume went up, it's lagging behind price. Looking at our advanced decline line study, showing an improvement with the NYSE, the S&P, the mid caps, and the small caps, well above their moving averages. Our trend, the ADX continues to go up, is above 40, it's above its moving average. That suggests we're in a strong trend. The green line is on top, so we default to positive, but it is declining, even though it's starting to round out just a little bit. The shorter term ADX also is extreme positive, the green line is declining, so we're seeing a confirmation between those two charts. Volume continues to be just at about average and dropping even to below average. Our short-term charts, we're still having difficulty coming up to the underside of this trend line. We've tried it twice now. We have to see if we can keep going up and eventually break through it. There's also resistance at previous highs that the market has been running into. And you can see down on the bottom where we're just a little bit below the moving average with volume. The 20-day exponential moving average is no longer extreme positive and showed some improvement. We were flat with the 50 and showing a little bit of an advance with the 200. The Williams percent R continues to be extreme positive. The CCI, a new addition to the list, has now gone into an extreme positive reading. The stochastic, still extreme in the short term, declining in the intermediate term, but still extreme, turning back up and showing some improvement in the long term and also still extreme. The force index continues to be above 0. That's positive. Our intermediate term charts, the balance of power declined a little bit, but we're still above the dashed line. The go-no-go system remains more neutral with a positive slant because we have the lighter colored blue bars. We're dropping off a little bit from the highest high reading here as we're chopping more or less sideways, but we're still above the midpoint and this is still looking healthy. TTM squeeze showing a little bit more strength. We turned back to the lighter shade of blue bar and the oscillator starting to turn back up. We're right at the top end of the second standard deviation, so that we're wearing off a little bit of that extreme positive reading. The rate of change going back 50 periods did decline, but is still extreme positive. Didn't see any change in the Erin. It's going sideways now. It's still suggesting that buyers are in control as sellers are decreasing. The S&P 500 McClellan oscillator is still above zero and advancing, so that helps the summation index. We're starting to break out a little bit above this previous high. We'll wonder if that can continue. We're pretty much sideways right now with volume, so we're seeing a little bit of a negative divergence here. The NYSE McClellan oscillator also showed an advance, so when we look at the summation index, we're improving based on price and volume, where volume is starting to break out and price continues to lag behind. The PMO starting to roll over more negative. We're turning down based on price and volume. In our PMO study, a little bit of an improvement with the PMOs that are rising. We're still declining with the buy signals, rolling over a bit with the percent of PMOs above zero. The Elder Impulse system for the S&P continues to be positive with a green bar. The Swenlin trading oscillator also is declining based on price. We were flat based on volume, but both continue to be above zero. The parabolic SAR is positive with the dots underneath. The slope oscillator is trying to turn back up a little bit, but continues to be under the moving average. The MACD is also dropping below its moving average. So when we look at all of our oscillators turning a little bit more negative in the short term, we're really flattening out in the intermediate term, and we're still slightly positive in the longer term. The Sean trend meter is still giving us an extreme positive reading. The bullish percent index is starting to come back down now. It's extreme positive. There are two ways to look at this. We're overbought and due for a pullback, or it's suggesting good momentum. But now that we're seeing this come down, we want to keep an eye on this. The NYSE bullish percent index did tick up just a little bit after it had been going sideways, so this is still positive. The Chaikin money flow continues to drop off on the daily chart. It's positive, but we're below the moving average. This also tries to measure what is the smart money doing. The Chaikin oscillator is still below zero even though it turned up, so this is negative but trying to improve. The money flow index is above 50 and advancing. The vortex has the green line on top. It ticked down just slightly, but it is positive still. Ultimate oscillator trying to come back up to this level, just barely crossing above 50, so it's switching back to more positive. With the RSI based on 14 periods and 9 periods, we saw this negative divergence here. We're wondering if another shorter term negative divergence is going to develop. So far, we're just waiting for that to play out. On balance volume continues to be positive and we're above an advancing moving average. The 200-day moving average study turning back up slightly. We're showing some improvement with the stocks above their 50-period moving average. The Copic curve is rolling over slightly, but it really hasn't crossed below the red line yet, where the Pring bottom fisher continues to generate a buy signal. Our Fibonacci and line studies just have one. We're coming up to August 1st now. We're wondering, this 50-day cycle, is that going to produce some kind of a change? Other times when we hit the 50-day cycle, it marked a low. Other times a top. Other times the market just kept going and didn't pay attention. Our different charts, the Heiken Ashi remains positive. The Kegi chart is positive, but we're ticking down with the black bar. The Renko continues to be positive, and the 3-line break is also positive. Our different indexes, the equal weight is showing some improvement and starting to pretty much match up with the S&P 500. We're seeing a bit of an improvement with the overall ratio as more stocks start to participate in the upward movement. Keeping an eye on Dow theory, breaking out still with the Dow. We ticked down just slightly with the transports. We also saw a little bit of weakness with the utilities. So far, the Dow and the transports are confirming this breakout, and weakness in the utilities is helping the S&P 500. Here's our ratio. It's still tending to go up. That's what we want to see in a solid environment. The transports are starting to outperform the Dow now as the red line goes above the black line. Our discretionary and staples equal weight study. We were up slightly with the discretionary. We turned down a bit with staples, so our ratio went up and we continue to be in a longer term uptrend. The Dow is still chopping sideways now, but hanging in there and holding up fairly well. The diamonds continue to be neutral, And the NASDAQ, we're wondering, can we get back up to this previous pivot level and break through that? If we fall, will this new pivot level provide support? Also watching the 61.8% retracement level. We're getting a little far away from that, but if we really start to head down, we're going to ask, will this provide support? We're seeing a bit of an improvement with the cumulative new highs, new lows for the NASDAQ, but they're still declining overall, even though the raw score down below is above zero. The NASDAQ 100, kind of seeing a similar situation here. Can we get up to this previous pivot level and then break above it? Or are we going to fall down to this pivot level and then eventually go down and hit the August 2022 high? As more time passes, if we do start to fall, the more likely this may offer support. The Qs still remain positive with the Elder's Impulse system. And the NASDAQ 100 BPI, it's rolling over a bit, is extreme positive, but so far it's been hanging in there. We're also keeping an eye on this. This is negative. Where longer term we saw a negative divergence with the PPO. It's starting to turn back up, but it hasn't crossed above its moving average yet. If we could see some more follow-through upside action on the NASDAQ 100, enough to cross above this moving average, that would turn things more positive. The small caps continue to show some strength. And here's where we broke above resistance on the Russell 2000. We came up to this level and we're finally able to get above it and then close above it. That's more positive for the small caps. We're coming up with the RSI and almost getting to an extreme positive reading. The MACD was starting to roll over, but now it's starting to turn back up. The Elder's Impulse system for the small caps is switched now to positive. The ratio between the small caps and the S&P did show some improvement, but continued to underperform. When we're looking at this as a couple of different ways. Number one, that the small caps are weak, and that could help bring the market down. The second thing is the small caps have been lagging behind. The rest of the market's doing quite well, so we might see some improvement to help the overall market. When we look at small cap growth versus value, we tick down just a little bit in the ratio, but continue to be in an uptrend. The mid caps, pretty much sideways, up almost 0.5%. We're still working off of this recent golden cross, and we switched over to positive with the Elder's Impulse system for the mid caps. When we look at mid cap growth versus value, after dropping down below the 50-period moving average, we are turning back up, and we still remain in an overall uptrend. The dollar was up slightly and is still above 100. We're keeping an eye on the FANG index too. We're coming back up to this previous high, which may still act as resistance. We're wondering, can we go back and test the all-time high that was set last week? We're still seeing overall strength in the home construction when we compare it to bonds. Looking at the bank sector, we're above the 200-day moving average, even though we were pretty much flat on the day, seeing some improvement here. The financial sector was up slightly. We're not quite ready to get a golden cross in this sector. When we compare the financials to the S&P, they still continue to underperform. The regional banking ETF showing a little bit of an improvement with the financial sector, but still declining overall. Looking at bonds, where we were down slightly with yields and we were up slightly based on price, but we're still below the 200-day moving average. This is one thing that's kind of going crazy now too, is the value to growth ratio. A lot of times they tend to match up with the 10-year yield. We're seeing them heading in opposite directions. But when we look at riskier bonds and compare them with more conservative bonds, folks are still favoring the riskier bonds. This is also a bit of a concern. We declined with this ratio, but we're continuing to go up when we compare cash with the 3-month bond ETF. We're also continuing to climb above this level that we set back in 2007. It's when we top and start to come down, that's when we're going to wonder, is this giving us some kind of a warning sign? Our long-term charts still looking positive with the special K on the daily chart. The weekly chart is improving a little bit, but it's still negative. It's below the red line. Our longer-term moving average study turning back up slightly with the 150 and 200 moving averages, and we're looking extreme positive. This is one that I pointed out in the weekly video where we came right up to this R1 level. That was the high that we set last week. And we're wondering, is that going to produce a problem? So we want to keep an eye on this, even though it's a longer-term chart. Also, this other longer-term weekly chart of the S&P 500, we're still above this resistance line. Can we hang out above that, or are we going to drop down below it? And seeing pretty much that same thing with the NASDAQ 100. Also, the ratio continues to be quite high. We have not been seeing it really decline as of yet, but other times when we got to this level, the market did have some trouble. This is after the 2000.com boom and then bust. This is when we started to run into trouble back in late 2021. Our possible positive scenarios saw some improvement with the Qs to the S&P, a little bit of improvement with discretionary to the S&P, and large cap growth went above the moving average when compared to large cap value. The growth to value ratios, an improvement with the large caps, mid caps, and a little bit of improvement with the small caps. The S&P to utilities ratio continues to go up overall. That gives good support to the S&P. We're still hanging out here in the upper range with our 10-day average of the highs minus the lows for the S&P 500. We're getting to a pretty extreme reading, which for right now, since we've been camped out here for a while, suggests good momentum. When we look at the broad range and take a 5-period moving average of the highs minus the lows, we dropped a little bit but still continue to be above zero. The 50-period exponential moving average of the new highs minus the new lows continues to advance. The black line continues to be above zero and the red line continues to go up. We saw a little bit of improvement with S&P growth versus value. However, in the shorter term, we have been declining, even though longer term, we're still in an uptrend. The Staples to S&P 500 ratio ticked down just a little bit, giving some support to the S&P 500. So what's our outlook for Tuesday? There will be some influential earnings reports that are going to be released. This will include Apple, Amazon, Merck, Qualcomm, and there's a whole slew of other companies that will also report. There's no scheduled Fed speeches for August. The technicals are still positive, and we're still working more towards becoming overbought. But for right now, if we keep going up, it's also suggesting good momentum. The economic reports coming out will get the final reading of the S&P Global U.S. Manufacturing PMI. Construction spending will also be released. The big one is going to be the ISM Manufacturing Index, and we'll also get the JOLTS job openings. We're also keeping an eye on all the different geopolitical events, but the market continues to be fixated on inflation and interest rates. Here's the updated economic calendar for the week. We're getting the ISM manufacturing on Tuesday. We're getting the non-manufacturing on Thursday, and then we'll be getting the employment report on Friday. I usually don't go through this as much, but since it's the beginning of the month, I wanted to do that. This looks at the yearly backdrop that I constantly refer to, and I like to go over it from time to time. The January barometer states that the year follows January 83.33% of the time, going back to 1950. We're working off what's called a trifecta, a 3-0 score. The first was the Santa Claus rally. That gave us a score of 1. The first 5 trading days in January were positive. That gave us a score of 2. The month of January was positive. That gave us a score of 3. When this happens and you go from February forward, we're up 87.1% of the time with an average gain of 12.3%. If you take the whole year, we're up 90.3% of the time with an average gain of 17.5% going back to 1950. The markets also like that we're split between Republican and Democrat. Going back to 1945, the Dow has an average of 16.4% when there is a split in Congress. Here's the Stock Traders Almanac statistics. Also, some new things to go through since we're starting August. Over the last 72 years, in August, the S&P's been up 55.5% of the time and down 44.4% of the time. We have the week of options expiration, which we tend to be a little bit more up than down. The week after options expiration, we're a little bit better on the upside and a little bit weaker on the downside. For Tuesday, August 1st, we're pretty much negative across the board with the Dow and S&P, where we're neutral to positive with the NASDAQ. Here's looking at that chart, showing some weakness coming into the early part of August. Here's another look at the chart. We'll be on the first trading day of the month, where we do see some historical weakness, especially during pre-election years. But that just is historically what has happened. It doesn't necessarily mean it's what's going to happen, but don't be surprised if it does happen. During the pre-election years, going back to 1950, for the month of August, the S&P is up and down 50% of the time. It's a coin flip. So our scenarios, not going with the down one yet. We're still looking positive overall, and as we continue to go up, we're becoming a little bit more overbought. But until we really get excessive to the upside, we suggest that might be just showing good momentum. So we're still defaulting to the positive scenario, even though we are potentially becoming more overbought. The one that we're definitely ruling out for right now is that we're not going sideways, because our ADX, it's above 40, let alone 20, and it's above its moving average, even though the green line continues to decline. The warning signs, is there going to be a convergence of these short-term bearish signals? Not really seeing that played out all that much, because we're not seeing an awful lot of follow-through weakness. The longer-term trend signals may be signaling that we're at a top. Those are the weekly charts of the S&P and the NASDAQ 100. So far, we're above that level, and it's not signaling that we're at a top. And we're coming into a weaker time at the beginning part of August. The oscillators are turning negative, especially more in the short term. We're flat in the intermediate term, still holding up okay in the longer term. It's the NASDAQ 100 oscillator that we're keeping a close eye on. The VIX is still showing that there's not a lot of fear. The cumulative new high lows, even though they're improving, are still showing longer term weakness. The 3-month yield, we're still going higher than where we were back in 2007. Growth for the S&P 500 is weakening, but it's still in an uptrend. And the weekly pivot, the new chart that I just showed, it may be acting as overhead resistance. We're going to be watching the 46.07 to 08 level. That's about where that pivot level is at. And then earnings season will be on a stock-by-stock basis. Our positive signs, we have seasonality and setups that I went through in the weekly video. Those are still in the background. The Stock Traders Almanac statistics, those are still in the background too. The daily special K chart continues to be positive. The weekly chart is still negative, but could be showing some improvement. The longer-term equity put-call ratio is still declining. That's positive. The S&P remains above the downtrend channel upper line. We're still in a risk-on posture, and we're seeing that ratio starting to go back up. Lower price levels may provide support, but as I've been saying lately, we really haven't tested those levels all that much. We've been holding up on daily pivot points. If we really start to fall, will it be a fib level? Will it be a previous high? Will it be a pivot point that actually ends up providing support? But so far, those haven't really been tested. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're still above overhead resistance, longer term. But we're still below the daily pivot resistance. We've been having a hard time getting through that. The Staples to S&P 500 ratio continues to decline. The Russell and the small cap index, as well as the mid caps, generated recent golden crosses. And small and mid cap growth continues to be positive. The Copic curve, we're not quite off of that buy signal yet, but it could go away pretty quickly, where the Pring bottom fissure has generated a recent buy signal. So our conclusion, the S&P remains positive, could be becoming overbought, but for right now, it looks like there's good momentum. But this could change at any time. We're positive in the short term and becoming overbought, as well as the intermediate term. We're still positive in the long term, unless you're a little concerned about the 150 and 200-day moving averages. Thank you. I hope you have a really good day, and I will talk to you in the next video.